In this video, I wanted to talk to you about ARM loans, adjustable rate mortgage. What is it? Why is everybody afraid of it? And I know what you're thinking right now when you hear a lender talk about adjustable rate mortgages. We all have a bad feeling, and because they have a bad reputation, and there's a reason for it. So I wanted to create this video for you, basically a mortgage 101 on ARM loans, on adjustable rate mortgages. What are they? Who is it good for? And is this something that you should be looking into? If you're interested, keep on watching. Most buyers in over a decade have been using fixed loan mortgages to buy a house. That means that they would get a loan secured for 30 years and then had a fixed rate. That means that the principal and interest did not change over 30 years. On an ARM, which is an adjustable rate mortgage, this is a loan product that allows you to purchase a home with a different type of financing. It's structured differently. You can buy a house with a 5-1 ARM, 7-1 ARM, 10-1 ARM. And basically what this is the number of the first number shows you for how many years it's fixed on a 30-year same term 360, right? So if it's 5-1, that means that the loan would be at a fixed rate for the first 5 years, and then it would adjust every 1 year. But there's a big misconception that everybody thinks that the rate will just keep going up and up and up, and that's not the case. The loan has caps in place, which means that the interest rate can go up to a maximum of this amount, and then you also have the max cap ceiling on the rate going forward for the duration of the loan. So if you start with a specific rate, it can go up by a specific percentage, and it will also cap out at a specific amount. It doesn't mean that you buy a house right now, get a rate in the fours on an ARM, let's say, and then you end up paying 12, 16, 18% interest rate. It doesn't go up that high. That's not how it works. So it's fixed for either the 5-1 is the 5 years. That's the first, how long it's fixed for the initial period of the loan. So if it's a 5-1 ARM, it's fixed. So the mortgage interest rate does not change for the first 5 years, and then it can adjust every 1 year. If you do a 7-1 ARM, same thing. It's fixed for 7 years, and then it can adjust every 1 year. A 10-1, it's fixed for 10 years, and then it can adjust every 1 year. Now, there are caps in place where it can increase to a certain amount. It doesn't mean that it's just going to go up forever and ever and ever. That's not how it works. So you have a cap, and then you also have the maximum, the ceiling on how high this interest rate can go ever throughout the duration of the loan. If you stayed in the house, if you kept it, and if you didn't refinance. So when you talk to a loan officer, make sure you talk to a professional. But once you get the documents and paperwork, you will know all the numbers. There's no hidden surprises. It's not that the rate will go up, and I just don't know what the rate will be. We have to go by the worst case scenario. And in today's world, when we actually qualify people for ARM loans, it's actually more difficult to qualify because you have to qualify with the worst case scenario. So you're not qualifying with the 4% rate, we're qualifying with the 6, 8, 10, whatever it may be, depending if it's a 5-1, 7-1, or 10-1 ARM. But that's just the main thing. And everybody still has the misconception. And it comes because back in 2007, 2006, when loans were originated that caused the crash later, there was, again, one of the things that crashed in 2008 when we had the housing crash was that the ARM loans were done incorrectly. Okay, what I mean by that is that it's not a bad product for the right person. If there's a right person that's financially savvy, you can still structure it where it makes sense. But back in the day, they didn't have caps. You had prepayment penalties. The buyers were not informed. They were not educated on what was going on. You had option loans. You had interest-only loans, and they were ARM products. So that's why there's a bad reputation for ARM loans, because imagine if they told you that, hey, you have an option to pay your principal, but you could pay just your interest on the loan. And this, coupled with the fact that the housing market actually crashed and there was a bubble with home values dropping, that put them in negative equities, and that's why we saw a wave of foreclosures. So the market is different right now. The mortgage industry is different. It's learned a lot about what happened. It won't happen again. And the housing market is way more stronger today than it is back in 2007, 2008. We won't see a bubble, and the house prices will remain. So let's talk about also the top cons and pros about adjustable rate mortgage loans. If you find this information helpful and you like this video, please don't forget to smash that like button, and please consider subscribing so you don't miss any videos like this in the future. Let's talk about the pros and the cons of adjustable rate mortgages. The pro, obviously, is that you can save money, okay? Now, we have to look at it. You have to look at the dollar amount, how much you're actually saving. Depending on the price point that you're buying a house in, it might be worth it or it might not. ARM products are usually in the jumbo world where it's a higher loan amount, a higher, more money that you're borrowing from the lender. So a difference of 0.5% will make a big difference on your monthly payment. So if you can save, let's say, it all comes down to how much you're saving on the monthly payment, how much you're saving in your monthly payment. For example, I've heard that ARMs are coming back. ARMs are coming back. They never went away. ARMs have been around. They're still here, but nobody talks about them because the fixed rates were so close and even better, and sometimes than adjustable rate mortgages. So since the rates are going up right now, ARM loans, we're getting more questions about it, but a majority of people, I'm talking about over 90% of people, still does regular 30-year fixed, 15-year fixed loans. That's 90%. So I think it's 9% right now is the average of people doing ARM loans, but they're usually in the jumbo world, which means they're above 647,200 on the loan amount. So anything over 647,200 in the jumbo world, if you can get a rate lower 0.5% than what you currently have, then it might actually save you money. If you're looking to buy a house in a 400 price range, 500, 600, the difference might not be big enough. But the main thing with the first pro with ARM loans is that you can save money if you live in the house for less than what the first fixed period is. Okay, so let's say you got a 10-1 ARM and you lived in the house for the first 7 years and you were able to capture a 0.5% lower interest rate. And that's another quick tip. In order for an ARM loan to make any sense for you, you have to get at least 0.5% less or 0.5% lower interest rate than what you can get on a fixed rate. If you can get a 0.5% to 1% lower, that would be fantastic. It's worth looking into. But because over the years, the last decade, fixed rates were actually a little bit better, or maybe there was like a quarter difference. It didn't make sense to talk about ARM loans. There was no benefit to it at all. But if you're in a higher price range above the 647,200, and if you can get 0.5% lower interest rate, well, now it's interesting, right? Because now we're talking about saving a couple $100. And when we look at the cons of adjustable rate mortgages, the first one obviously is that the mortgage rate and your payment will go up. So that's something you have to be prepared for. Remember, when you talk to a loan officer, they will give you the numbers. They will give you the caps and the ceiling. So you will be prepared on what is the lowest payment today and what is the absolute maximum. And you have to be okay with both numbers. You know that today, this is how much I'm paying. This is what my rate is. And then the worst case scenario, if your rate were to go up and up and up and up, when is it going to cap out? What is my ceiling? What is the maximum absolute highest payment I will have? And if you're okay with both those numbers, you can look at it. But that's the con, is that it can go up and the rates will probably go up, but they will come down. So we really don't know what the market is going to do. Rates are kind of crazy and all over the place. They go up, they come down. But what it will do when you are ready to refinance or to sell, that's a whole different story. So the first con is that the rates and payments will go up. Second one is that it actually is harder to qualify to get it because even though you're getting a lower interest rate today up front, we have to qualify you on the highest worst case scenario. So you have to qualify with a much higher interest rate. So that would be the second con, is that it's actually harder to qualify to get it, and you need a bigger down payment as well. And then the third one is that we really don't know what the mortgage world, the mortgage industry will look like in 10 years, right? We don't know how the guidelines will change. We know that it changed. We know that today you qualify, you can make the payment, but in 10 years, if you lose your job, if your credit scores drop, like, we don't know what's going to happen, right? So that would be the other con of doing an adjustable rate mortgage. I know in this video, I'm just touching on the basics, right? The basics of an ARM loan, the basic of an adjustable rate mortgage. But if you want me to do another video and go in deeper to look at some specific or more exact numbers, leave a note in the comment section, let me know, and I can make another follow-up video to this. In conclusion, what I wanted to say is that ARMs, again, 90% of all the loans happening right now, it's still fixed loans. It's still 30-year, 15-year fixed loans. ARMs, they haven't gone away. They've always been around, but because the rates are going up, now they're becoming a little bit more interesting. So in conclusion, what I think you should look at is that it's not a bad product if it's for the right person. So if somebody is financially savvy, they're in a higher price range in the jumbo world. So, $1 million, 800,000, and you can save 0.5% on your interest rate. That's enough of a savings that you might want to look into doing it. But you have to know that for the first 5 or 7, I probably will recommend 7 or 10 years if you're going to do an ARM loan, and you think you might stay and live in that house for 7 years, do an ARM loan for 10. Okay, give yourself a little bit of extra cushion, but you have to have an exit plan. So if you have an exit plan, you have a strategy, some money coming, like you have a way out, and you can either refinance or pay it off completely or sell it. So if you have an exit plan, an ARM might be a good product if you're in a higher price range. If you can save $500, $600, $800 a month, sure, look at an ARM product. But if you're planning on living in the house in a lower price range for a shorter time, again, that it's a good product. But if you're planning on living in a house for a longer time, if this is your forever home and you're in a 400, 500, 600 price range, and this is your forever home, probably might not be a good option. I would recommend still doing a fixed loan. And again, if you look at some numbers historically, if we look at data, 82% of all the home buyers will sell, refinance, or do something with the mortgage. 82% within the first 10 years. So nobody really stays in the same house really for that long. And if they do, they definitely don't keep the same mortgage with the same rates and same terms when they purchase the house. A lot of people refinance, shorten the term, extend the term, do a cash out, whatever the reason might be. You will probably do something with the mortgage. So if you're going to stay in the house for 10 years, either sell or refinance or keep it. Again, look at your options. If you're going to stay there, if you can probably sell it or refinance before the first fixed period ends, then you can look into it. But if you want to stay there for longer, then just still stay with the fixed rate, because most of the people were still going with fixed rates. Hope you find this helpful. I know it's the basics. Again, if you want me to dive in deeper, let me know in the comment section. And if you find this information helpful, make sure you smash that like button. Don't forget to subscribe, and I'll see you in the next video.